All right. First off, I want to thank everybody for making time on a Monday night to join Michael and I to discuss this investment opportunity that we're putting forward for 1505 East 11th Street in Long Beach. A couple housekeeping items before we begin. This Zoom call is going to be recorded and will be available on our Appfolio site. We do ask that all callers leave their phones on mute. At the end of our prepared remarks, we will have a question and answer session. So to the extent you have a question, please feel free to put it into the chat and we'll do our best to get to all your questions during this meeting.
Yeah, welcome everybody. Thank you. Excited to have this call and present this property and investment opportunity. Michael and I have talked about doing something like this for a long time. And one of the reasons we're doing this is because we love the idea of being able to share with people what we've learned, the power of investing in real estate, and hopefully create some more investors out there, even if at a small amount now, maybe transition to larger real estate investors in the future, because we do believe it's so powerful. So now, Michael.
All right. So we have a real great team of lawyers whose job is to make sure that we've made you all aware of all the risks and uncertainties that come along with investing in real estate. But we encourage everybody to read the statements that are on this presentation thoroughly. Two things I would like to point out on these statements is that during our presentation, we're going to be making forward-looking statements regarding our expectations and objectives for this investment. And the forward-looking statements are based on our beliefs and assumptions as of today. Factors or events that could cause actual results to differ may emerge from time to time, and it's not possible for us to predict all of them. We undertake no obligation to publicly update any forward-looking statement, whether as a result of new information, future development, or otherwise, except as may be required by law. Additionally, this offering of security is being made only to accredited investors and non-US persons as defined by the Securities and Exchange Commission.
Wow, and thank you to our securities attorney for that one. We've got to share that with all you guys.
Yeah.
But all that, and that's a kickoff to something really exciting, which is to say that we've identified an opportunity to acquire a 21-unit building in the rapidly improving Lincoln neighborhood of Long Beach. This building has slightly below market rents. It presents a unique opportunity to convert garages into ADUs, and we'll go into some more detail about what that means later. And also by bringing rent to market through a combination of turning units as well as annual rent increases. The building was built in the 1960s, which is something really positive for us. There's a lot of older housing stock in Long Beach. So this is one of the things that makes it a great opportunity. And probably one of the coolest things about this property is that I currently manage it and have for the last 2 years. And so if anybody's going to know which skeletons are in the closet, I would be that person. But the building has been operating nicely over the last 2 years. And I'll give you some more details as well in terms of the initial inspection. We did the inspection that my current client did 2 years ago. We've done similar inspections now, and it's been interesting to see the changes and frankly, the improvements, because the current owner and current management company has taken good care of the building. So Michael, go ahead and finish this off here.
Sorry, I go on mute. Yeah, I'll give you all a little highlight of the expected returns on this investment opportunity. Right now, we are offering on this investment opportunity a 7% cumulative and compounding for return, and we'll be making quarterly distributions of available cash flow. In the later slides, I'll be going over our forecast results. But at a high level, we took a look at this opportunity under two scenarios. One in which we refinance after 3 years, and one in which we don't refinance after 3 years. And I'll explain why later, why we looked at those two scenarios. Both of these scenarios assume a 5-year hold. And in the first, where we're going to be refinancing it, we think there's an opportunity through increasing rents and building the ADUs that we could capitalize on some of the appreciated value in the property, get investors caught up on their preferred returns, and actually return a significant amount of their capital earlier on in the investment time horizon. But even if we don't do that, we still believe there are some good opportunities for solid returns here if the financing markets are working against us, if it's just not the right time to refinance, or if we're just not going to get sufficient proceeds to make it worth everybody's while. Um, so one of the interesting things that you'll see here, and you'll notice later on as well, is that while we have a scenario we call an upside scenario that generates a better internal rate of return, or IRR, for our investors, the downside scenario actually returns more cash. It's just that it's more back-end loaded. Again, two pretty palatable options that we think we're offering here to investors. For the monthly the quarterly cash distributions, in the first 2 years, we expect those to be somewhere between 3 and 4%, because our available cash flow is going to be a little bit lower as we turn those units over and construct those ADUs. But then afterwards, we expect the quarterly cash returns to be 7% or better on an annual basis. And what we are focused on a 5-year hold for this investment, but the ultimate exit time frame is going to be dependent on market conditions, as always. Last point on this slide is that as sponsors, there's always customary fees that somebody like M Squared will earn, and we note those in detail on slide 19 as well as the appendix. At the end of the day, our job is to generate strong risk-adjusted returns for our investors, and accordingly, the bulk of our compensation is tied to your success, as it should be. To further align our interests, Michael and I together are investing 10% of the required equity in this opportunity from our own pockets. Put simply, we wouldn't ask anyone to invest in this property if we wouldn't be willing to put our own money on the line.
All right, well, to tell you a little bit about our past here, M Squared Investment Advisors, we were named M Squared because we are two Michaels, and we figured, what the heck. It also is a play on words and hopefully exponential returns for M Squared. We are the sponsor of the investment of this syndication. And Michael and I thought about doing this about 8 years ago. We talked about it, and boy, hindsight is 2020. We wish we would have done it 8 years ago, but late is better than never. And we see us having a lot of tailwinds over the next several years in terms of investing in real estate, inflation, et cetera. So just to give you a little bit of history about myself, I am the CEO of Vorber Property Group. We manage 3,400 units, and a little over half of them are in Long Beach. I've been with the company since 2001, but my family has been brokering, owning, and managing properties since the late 80s. Since 1986, we celebrated 35 years this year. And I am a licensed broker and certified property manager. I started with a BA in finance from Cal State Fullerton, and later an MBA from USC. And I'm also the owner of over 80 units in Long Beach and the surrounding cities. And I've been an investor since 2004.
So like Michael, I've been around real estate my entire life. My parents have owned several apartment complexes in the Long Beach area since I was young. And while doing my undergrad, I worked for a commercial real estate developer and property management company, where I got my first experience or first exposure to the operational side of the business. I too went to Cal State Fullerton, go Titans, and got a degree in accounting there. Went on to do public accounting for 6 years, where my main clients were real estate investment trusts, or REITs, and home builders. I left public accounting and went into the corporate world, where I first worked at a sponsor for some non-traded REITs. And then for the last 11 years, I've been at a publicly traded REIT that has a $6 billion enterprise value, where I currently am the executive vice president of finance and chief accounting officer. I'm a licensed real estate broker and a certified public accountant in the state of California. And I've also been an investor in residential and multifamily real estate since 2004. So despite our backgrounds and our experience, one thing neither of us has ever done is put together a syndication. So from the beginning, it was important that we surround ourselves with experience and knowledge in this world of real estate syndication. And that's exactly what we did. So we wanted to highlight a few of the advisors that we've leaned on during this process. There's several more, of course. We're learning all the time, but we really wanted to highlight a few of them here as part of this presentation. The first is Anthony Horgan, who is a partner and co-founder of Reliance Law Group, and he serves our general counsel and our securities counsel. He's the guy who wrote that lovely introduction that I got to read to everybody. Anthony has extensive experience in many areas of corporate and securities law, including real estate syndications. And if one Anthony as a trusted advisor is a good thing, two is even better, because we have Anthony Walker as one of our advisors as well. He's the CEO of Buckingham Investments, which was founded in 1963 to provide investment real estate brokerage services to investors in the greater South Bay area of Los Angeles County. Anthony is a sought-after expert when it comes to multifamily investment in Los Angeles County and the South Bay. And Anthony is also representing us as our broker on this investment.
So before I get to our two Jims, I just wanted to mention that the founder of Buckingham, Marty Stone, I've been trading emails with him about this as well. And he's given me a lot of insight because Marty used to be a developer, property manager, broker, and do construction as well. And so he's been sort of guiding me as well. So it's really neat to have those two, and of course, Anthony Horgan on our side. And now for the two Jims. Jim Shute is a gentleman that I met about 10 years ago, and my first exposure to syndication was with Jim. He was syndicating properties in Long Beach and has now moved to syndicating properties in the Midwest, and he's sort of moving back to Long Beach. I think he's planning on doing some local syndications. So I was involved as an investor on some syndications, and we had also done some flips. And so that's how I met Jim. I still manage the properties that we syndicated with Jim's many years ago because the partnerships bought some of those properties from the investors. And so Jim has looked over everything with us and for us, and he's been a big help along the way. Jim Frings is a client of mine. He's been with us since 2009. He syndicates property in Wisconsin. And he's an investor in this syndication, and he's also become a good friend and mentor. Both of these gentlemen have really helped us in developing this offer, in addition to, like Michael said, a lot of other people who know this side of the business and who are rooting for us in this property, and have been a huge help. So I'm going to give you a little bit of background now. This building was built as 21 units in 1964. Something interesting happened in the 90s. I suspect it was because the on-site manager was in a studio, and the owner then converted it to 20 units with permits. And then later, sometime along the road, we don't know when, that unit was converted back to 21 units without permits. So this is part of the tailwind that I mentioned earlier. We're going to be able to take advantage and have the documentation required to successfully apply for amnesty. That is, we're going to be able to return these properties to this property to 21 units because we have all the information we need to be able to do that, aside from creating the ADUs. As I mentioned before, also property operations are well known because we currently manage the property. But probably the biggest opportunity that we have is to create ADUs, up to 5 ADUs at this property. And if you haven't heard what an ADU is, it's basically it's called an accessory dwelling unit. And because of in response to the California housing shortage, the state has passed laws which will allow people to add ADUs. In the case of this property, we're able to add up to 25% of the unit count in ADUs in buildings that are 20 units or greater. So with this particular building, we are going to be able to add up to 5 ADUs, and Michael will go into a little more detail about that later, without any concern for parking limitations. The only thing that the city can do is the city can create their own restrictions and create their own guidelines in terms of developing these ADUs. And luckily, we've been connected to the architect in Long Beach that helped Long Beach create those guidelines.
Yeah. So the key. One of the key factors to making this syndication successful is the construction of those 5 ADUs. So we wouldn't want to go into this opportunity without having a high degree of certainty that we could actually build those ADUs. So as Michael said, we have consulted with an architect who helped put this all together for the city of Long Beach, and did a feasibility study which confirmed that we'd be able to build up 5 ADUs on the property. For our forecasting, though, we've only assumed 4 ADUs are built. And the reason why is, and Michael will show this a little bit later, the way that the garages are laid out, it's going to be really easy to do 4 ADUs. Not a lot of brain damage there. There may be some structural changes we would have to make in order to build the 5th. We're not sure, but it's something we're going to look into. but just to be safe and to be conservative in our assumptions, we just assumed that we would do 4 ADUs. But as we get into it, if the modifications to build that 5th ADU are minor, or if the cost to construct it aren't egregious, then that will provide even a greater opportunity to improve the returns on this investment. We've actually started talking to architects to help us draw up plans and get the ball rolling on these ADUs. And we're hoping to set the architect that we select, hoping to set them loose in October, which will allow them to hit the ground running on the ADUs, or allow us to hit the ground running on the ADUs once we close escrow. For our assumptions, we've assumed an 18-month construction timeframe to get the ADUs built, and then we would lease them out. So the sooner we can get started on those, the shorter that time frame will be, and then the sooner that we could start increasing, cash flows and distributions to you all. So a little bit about the market where this property is located. So it's located in the Lincoln neighborhood of Long Beach, which is up and coming area of the city. The major cross streets are Walnut and Anaheim. It's actually a really great location for people that want to be close to downtown Long Beach, whether that's work, entertainment, or both, and don't want to pay rent or the downtown Long Beach rent. It's less than 2 miles from downtown, less than 2 miles from the beach, less than 2 miles from all the entertainment venues in Long Beach. What's going to be very important to this development and the neighborhood at large is that it's getting a major boost from 116,000 square foot mixed use development that's going up literally around the corner from this building. In fact, when Michael and I were at the property inspection a couple of weeks ago, we were walking the roof and we could see just on the other side of the block, they're already breaking ground and the development was beginning, which really made us really excited for this investment and what that was going to do for the neighborhood and just for that general area. In one of the appendices, we have a link towards a link that kind of gives you a background on that development, a nice picture of it too, so you can get familiar with it.
Yeah, it was actually pretty neat when we were, we knew that permits had been pulled for construction, but to be walking on the roof and to see them, starting to break ground a couple of weeks ago was neat. So most of the properties that I own and manage are in Long Beach. As many of you already know, it's really transformed in the last 20 years, and it doesn't seem like that, like it's going to let up. Long Beach has had really strong occupancy and rent growth since 2013. Current vacancy rate is 3.6% when you're looking at CoStar reports. And I also keep track of all this information twice a week. I download this data, including so occupancy, collections, and leasing. And you can see about 15 months worth of data in the appendix. But today was really interesting because it's the first time in over a year, and vacancy rates were very low during the height of COVID, but for a different reason. Right now, vacancy rate dipped down below 3%. It's 2.95% today in our Long Beach portfolio, Long Beach and surrounding area portfolio. So it's been telling me, it's been going in this direction for a while, and it's telling me how tight and how strong the rental market is. It's interesting to me that Long Beach is a prime coastal community in the 6th largest city in California, and you can buy apartments 2 miles from the beach for $250,000 a door. And so when I think of Long Beach and how much growth is coming, I consider if this property were in Redondo, what would these units be going for? $550,000, $600,000, maybe more. And sure, it's going to be a long time, and I'm not suggesting that we're going to be able to sell these units for $600,000 a door in a few years, but I am saying that there's a lot more room for Long Beach to grow than there are some of these other communities. And Long Beach has done a good job of investing into the community. Speaking of investing in the community, Long Beach is poised to grow because there are a lot of jobs being created in Long Beach right now. Specifically, the aerospace industry is growing again, and 1,400 jobs have been created over the last 2 years, and that activity continues to tick up. And so there are a lot of other employers moving to the area, and I think Long Beach continues to be up and coming. Rents are presently increasing at 5.3%, which is huge. And we've projected for our assumption for the timeline for the model for our 3 to 5 year hold is 4%. Also interesting to note, the average household income in the area is about 64,000 compared with almost 68 in the rest of Long Beach. And I thought that this was interesting. I expected that it would be a little bit lower than that. This is higher than I thought. Remember, Long Beach has a lot of affluent areas. And so this and the development that's going up around the corner, which is really going to have an impact, I think, on our development here and what we plan to do, is just more information that makes me bullish and feel good about what's happening in Long Beach.
So the sellers of this property were asking $5.5 million, and we were able to get this property under contract for $5.4 million. So that $100,000 price reduction in itself is great, but what was even, arguably bigger was the fact that we were able to get a 98-day escrow with 2 one-month extension options. We expect to exercise one of those options and the second one if necessary. Michael and I put the down payment or the deposit down on this property to get under contract, and we started our diligence almost a month ago. And that diligence period expires this coming Thursday. And thus far, we haven't found any significant issues through diligence, and we don't expect to ask for any credits or price reductions. But Michael's going to give a highlight of a few concessions we plan to request in exchange for removing our contingencies later on this week. Regarding that price that we've negotiated at $5.4 million, that equates to $257,000 per unit, which is 2.7% below the market price per unit. If we're able to add those 4 U's that we've been talking about at a projected cost of $175 per square foot, that would bring our all-in cost of this property to $5,680,000 or $227,000 per unit, which would be 14% below market of the market comparables that we're seeing out there. So if you think about this like in a stock portfolio, it's like dollar cost averaging. And what this will allow us to do is give us a relatively lower cost base on a per unit basis, so that it would be easier to clear once we sell the property.
So our due diligence period is up on Thursday. Like Michael mentioned, we've done a lot of due diligence. There really are no red flags. But what we are going to do is ask for a few concessions to reduce risk. We're going to ask the seller to allow us to make some rent increases before close. We're also going to exercise our option to extend 1 month. We will extend 2 months if necessary, but the hope is that we can close this year, in large part so we could do a cost seg analysis, and Michael will go into that later. But anyway, so far, really no major issues with DD, and we don't expect anything else to come up. And so now I'm going to show you some photos of the property. You guys all have the link to online. There are a lot more photos online, but I do want to highlight some interesting stuff. And on the left-hand picture here, on the top right, you're going to see that large lot where that development is going to go. And that street right in front of it is Anaheim. So Anaheim up there and Walnut just to the right. But anyways, that's the roof we were on looking at that lot and then breaking ground just a few weeks ago. On the picture on the sorry. That's right. The picture on the right-hand side there, well, we're going to see the garages a little bit more, but I'm going to go into some detail. You'll see the 7 garages there on the right-hand side. Then you've got a breezeway, a walkway to the courtyard. You've got another garage, and then you've got a similarly sized laundry room on the left-hand side. So go ahead, Michael. So the intention there, looking at the left-hand picture now, is in the first 7 garages, we are going to be able to relatively easily modify that because we believe this used to be carports. And so those, it doesn't seem like there's a major structural component after garage 3 and after garage 7. Our intention is to have 2 smaller studios in the first 3 garages. Those are going to be probably in the low 300 square feet. And then the second 4 garages are going to be split evenly into 2 ADUs, closer to 400 square feet, an average of 370 square feet per ADU. The breezeway is where we intend to relocate the laundry machines. The breezeway is 1 garage wide, and it doesn't need to be that wide. but we're not going to mess with the walls there. There's obviously a structural component. And then the fifth ADU, which we don't know if we're going to be able to build or not, is the eighth garage, the final garage, and the laundry room. We would like to be able to convert those into one ADU, but there is what looks like a structural wall in between the eighth garage and the laundry room. Now, it may not be load bearing, we just don't know, but those are the things that we've got to look closer at, and we've made some contingency for. But it also, of course, depends, the development of a fifth unit depends on whether it's going to make financial sense, and we're going to investigate those costs in a lot more detail over the next month. Next photo. All right, so here you see the middle and the right photo are the top level, looking into the courtyard, and the left picture is the center level. Now, what I'd like to point out here is we've got an interesting idea, and that is most of these units are 2-bedroom, 1.5 bath, 2-story units. So the front door is in the middle level, and the back door, let's call it, is on the top level. So these doors that you're seeing on the top level in the center and right photo, they're in the bedroom, in one of the upstairs bedrooms, because they're two-story units. And so what we'd like to do, if we don't have any egress issues, and I don't think we will, because we have stairs on both sides of the property, we'd like to create some outdoor space for those residents to be able to use. I think that's going to add value. And I didn't mention it earlier, but we'd also like to create some outdoor space in the where the garages are right now. Some of the ADUs will have access from the courtyard. That's ideal. Some of the ADUs must have access. Probably one or two of them must have access from the driveway. And either way, we'd like to be able to put between 4 and 5, depending on how many ADUs we have, patios in the driveway. I also didn't mention that we are displacing some parking, obviously, to be able to build these ADUs. But another thing that we're going to be working on with the architect and the city is being able to put 5 parking spaces. Now that we don't have to be able to park in a garage, we might be able to do parallel parking up against the wall and one deep in the driveway next to the parking. So those are all things that we're working on, and we haven't even considered that the potential income from a lot of those things. Those are we've been very conservative with our assumptions. And I'd much rather say we're gonna try and get a 17% return and come up with a 20 or 22% return, then say we can get you 20 and come up with 18%, 2% short. So anyhow, we've got a lot of great ideas that I think are going to add value to the property. And the next slide are some of the upgrades that we've already done. You'll hear this in a moment, but 8 units in the building have already been upgraded by our company on behalf of the seller or my current client. So this is sort of a model of what you're going to see all these units being upgraded like. On the bottom left picture, you'll see the stairway, just to give you an indication of what those 2-bedroom, 1.5 bath units look like. In the back there, you've got the kitchen. On the right-hand side, you have a half bath. And then upstairs, you have a full bath in between 2 bedrooms. So as I mentioned before, the strategy is to add value through bringing rents up to market, either organically or through turnover, and increasing the income generation potential through construction of ADUs. So rents are currently 14% below market. That's not too little, not too much. I consider that in the sweet spot, and I'm going to explain that in our next slide. But also, I want to mention that rents that are currently below market are projected to move much faster than rents will move in general. So we'll talk about rent control more, but the rents that are well below market, we're going to be able to do 8 to 9% increases for the next few years. And our projections include models for each unit, vacancy lengths, and subsequent vacancies. So we're not just doing 3%, which is what is in the market, 3% vacancy. We're projecting a lot more than that, again, being conservative with our assumptions.
Yeah, so in terms of the ADUs, we're assuming $175 a square foot, which comes out to $280,000 in total estimated construction costs. And that is the cost of architecture, engineering, and construction. And as you saw in the picture, since those structures are already built, we're not building them completely from the ground up. The majority of that cost is going to be for soft costs, finishing the units and bringing services into those ADUs. Based on market comparables, we think that we can get about $1,500 per unit for those ADUs. So if you think about that, $1,500 for 4 units for 12 months, that's $72,000 on a $280,000 investment. That's 25.7% return on the incremental investment, which is huge. And then if you think about the value creation opportunity, this is big, because if you take that same $72,000 and apply a 5% cap rate, that's a $1.4 million of additional value, of additional potential value that we've added to the property once those are built and once those are rented.
All right, so next is the bad word, and I've heard it referred to as a bad word when we talk about rent control, but really what I'd like to highlight here is that it's not really as bad as it seems. On January 1st, 2020, AB 1482 is enacted as statewide rent control. And probably the worst part about it from a manager's perspective, and I think also from an investor's perspective, is it's difficult to get to relocate residents that are problematic. In terms of rent increases, it's quite manageable. It limits rent increases to 5% plus CPI. So this year we were able to do 8.6% rent increases. And these are still substantial rent increases. And only a few of the rents in this building are more than 20% below market. And we have tools to try to remove those residents or relocate them and put residents that are willing to pay market in those units. But let's just assume that we didn't, or that it didn't work. We would still be able to approach market within just a few years. We'd be able to catch up with market. You also have to consider that market for one of these units is less than it is after we're going to take the unit and put some money into to improve it. So as our rents approach market, it's going to become easier and easier to remove these residents and get residents inside the building that are willing to pay market rents. So this means on average, total rents can be brought up to market within approximately 2.5 years, some more, some less. Another concern that hopefully will be managed more quickly beginning in October is that there has been a California eviction moratorium, which is set to expire on September 30th. Now, in this building, we do have some residents that have not paid rent in a while. We are working with these residents to try to get a lot of the rent paid through SB 91 funds, through state and local methods of distributing federal funds. And so probably the most important thing to note here, though, is that I believe that on October 1st, a lot of these residents who have been saving money for a very long time, because most of them have not been impacted financially to the degree that they're showing on their rent rolls, I believe that these people are going to start paying. If they don't start paying in October, then we're going to be able to begin evictions, and that is one of the concessions that I'll ask for from the seller to make sure that we're able to start those evictions. They are able to start those evictions, and we're able to continue them when we take control of the property. For units that are significantly below market, we can offer tenants compensation to vacate their units. We do this all the time. It's called cash for keys, and we've set out $2,500 per unit. As I said, after the next rent increase, their units are going to be even closer to market. It's going to be easier to negotiate this. And we're going to try right away to negotiate cash for keys. We have modeled that I think 4 in the first year and 3 in the second year. But we're going to attempt to move as many of these residents, relocate them, as many of them as possible right now, so that we can improve the IRR for the building. And 8 of these units have been turned over the last 2 years. That leaves 13 units occupied and to be renovated.
So of those 13 units that are left to be renovated, we've staggered out the timing of those renovations, with 5 being turned in year 1, another 5 being turned in year 2, and then the last 3 in the 3rd year. In each of those cases, we assume that those units are taken offline for 2 months while we renovate them, and then get them leased at market rates. Of those 13 units, I think as Michael had just mentioned, there's 7 of them that we consider well below market. And for those that we will be paying the tenant $2,500, or assume that we'll be paying the tenant $2,500 to vacate, so that we could get into those units, renovate them, and bring the rents up.
Yeah, some people have told me that that seems a little low. Generally, we're able to negotiate cash for keys in that range. However, I don't think we're going to have to negotiate this for all of them. So some of them might be 5,000. Some of them might move with their next rent increase, and that's going to be what we'll be working on. In terms of these renovations, you'll see some costs there. That those costs are in line with what we're paying right now for the type of renovation that you saw in the photos I showed you earlier. And the total capital spend in the first 5 years is estimated to be $523,000. So you'll see there ADU construction, cash for keys, and unit turns. However, we're only raising $77,000 plus $280,000 right up front. Right, the rest of it is going to be through cash flow that we'll have in future years. Again, projected to be funded out of operations. So financing is a big part of this property. It's probably one of the things that excites me the most, because we've been working with a financing partner of ours, Fidelity, and they showed us, they went to a lot of different investors, banks, and they showed us 3 or 4 initially that were sort of okay, kind of exciting. And then at the very last minute, we had this lender that came in that offered us up to 70% LTV. So on this one, we're capped by debt coverage ratio. We're going to be able to get loan proceeds of between 3.6 and 3.675 million. This also provides us with a lot more flexibility to be able to refinance in the future. And what I mean by that is the initial loan we looked at, even though the interest rate was a tiny bit lower at 3.05, it had a 4-year prepayment penalty. So if we intended to refinance in year 4, we were going to have to pay $37,000 point just to refinance. So we were happy to take a 10 basis point increase in interest rate. And also it's interest only for the first 4 years, which is a big bonus as well in terms of being able to return or to create a return for our investors. And finally, this is a floating rate. It's SOFR plus 225 basis points, and that's starting in year 6. Chances are we're not going to have to worry about that. We may have to begin paying fully amortized payment on year 6. But it just depends on if we're able to refinance or, sorry, yes, year 4. It depends on if we'll be able to refinance or not.
So a couple projections that I wanted to share with you all. So when we started running our various models and trying to figure out, okay, what do we think this property is going to perform at, and what can we tell investors to expect in terms of return? We first looked at a downside scenario where we said, what if we can't build any ADUs, and what does that return look like? But once we got the feasibility study done, we ruled that out as a possibility, just because the opportunity for value creation through the ADUs is so great that, and we have the ability to do it. So there's little risk to that we just focused on a scenario where we do a refinance in beginning of year 4, and one that we just hold on to this and sell it in year 5. And what we have here, as I mentioned earlier, is in the scenario where we refinance in the beginning of year 4, it's technically month 37, the first month that we could refinance this after not having a prepayment penalty. We're able to return 75% of investors' capital. As you'll see there in the middle of the page up top or under year 4, we're able to return investor capital. We're able to get all the preferred returns caught up at that point. And then, with available cash flow, continue staying current with that 7% preferred return and returning even more capital to investors with an ultimate exit in year 5. And that, as we mentioned, results in an IRR to investors over that 5-year hold of 17.5%. On their downside scenario, you see that we don't do the refinance. We get caught up on the preferred return somewhere in year 3, start paying even more in year 4, where you see that 8.8% cash on cash return to investors. And then ultimately in year 5, we sell the property, return or get completely caught up on the preferred returns with investors, return all the capital, and then still, book of over 15% IRR to investors. But as you can see, there's more cash being distributed in that scenario. So it's really two really good options that we have at our disposal. If the finance markets aren't cooperative, once we get out to year 3, then we could hold on to it and just return more cash to people. It's a pretty good problem to have there. On the right hand side, I just want to point out that we show some sensitivities to to the exit cap rate. This is one of the several conservative assumptions that we think we believe are conservative in our forecast, is that we're assuming a 5% exit cap rate, amongst a couple other conservative assumptions that I'll lay out for you all. But that 5% exit cap rate is about 100 basis points higher than the cap rate that we're going into this investment with. So we include that sensitivity here so you can see, well, if we sold this property at the same cap rate that we bought it at, you're talking about call it a 400 basis point increase in your IRRs over a 5-year hold period. A couple other areas and a couple other assumptions we think that there's some room for improvement. We're assuming annual rent increases of 4% compared to a maximum locally of 8.5% and the standard market increase of 5%. When we're forecasting units to be turned, there's 2 months of vacancy, and we're adding on top of that a 3% vacancy factor. So all in, over that 5-year period, our average vacancy is 5.7%. Currently, market is just over 3%. As Michael mentioned, his latest numbers show that it's just dipped below 3%. So we think that we're being pretty conservative on that front as well. We're assuming operating expenses and insurance expenses to grow at 3% per year, property tax to grow at 2% per year. So overall, several different areas where we think that we've built in enough conservatism into these numbers that we feel confident in being able to hit that for our investors. We talked about the cash on cash returns, and one thing that's going to benefit investors that is not reflected in these numbers is a cost segregation study that we're going to be commissioning. So for those of you that aren't familiar, a cost segregation study for real estate investment takes a deep dive into the property related costs and then separates out the costs between personal and real property and figures out which of those capitalized costs can be depreciated more quickly. What that results in is higher depreciation expense to our investors, which lowers the taxable income from this investment in each year of the hold period. Since every investor's tax situation is unique, we couldn't model that benefit directly in here, but there's a definite benefit that our investors will realize by us doing this cost segregation study. On this slide, I just want to highlight some of the fees that as sponsors, will be part of our agreement to manage this venture. We have a detailed slide later on that I'll highlight as well, but I want to give you the highlights here. So one of the things with sponsor fee structures, it's obviously a very important part of the syndication because there's always legitimate costs that sponsors incur and risks that they take on to put these opportunities together. And getting compensated fairly for that, I don't think is ever controversial. But where issues arise that I've seen in my experience is in 2 areas. The first one is that when sponsors are making fees for anything and everything under the sun, regardless of the performance of the venture. We went out and looked at several different syndications to get a sense of what market was for these types of fees. And we saw some sponsors having upwards of 7 types of fees that they would charge their investors. And we just thought that was crazy. So we wanted to keep this as simple as possible. So our fee structure really comes down to 3 fees. We have an acquisition fee that's 2% of the purchase price, a disposition fee that's 1% of the sales price, and an annual asset management fee of 50 basis points of the invested capital balance, which comes out to about $11,000 per year, which basically covers our expenses and our overhead for managing this investment, software, insurance, things like that. The second thing that creates an issue, at least that we've seen, is when the sponsors and the investors, their interests are not aligned. What do I mean by that? So syndications typically have a mechanism to reward the sponsor for performance over the life of the investment. And those are sometimes referred to as success fees, incentive fees, or promoted interest. And like the fee structure I noted earlier, we've seen various different structures in the market of how people structure these. And one that's becoming more and more common, we've noted, is one whereby once investors get their preferred return paid, they get their capital returned to them, anything that's left over is split 70-30 between the investors and the sponsor. We've also seen, in addition to that, several structures where there's a catch-up provision, which basically says that the sponsor gets caught up to the investor returns and basically is on equal footing with them before they start splitting anything 70-30. So the thought behind that, in reading and researching on that, is that the sponsor is doing all this work all along the way and shouldn't be left getting nothing if the investment doesn't get a certain return. And while we can sympathize with that sentiment, because there is a lot of work that goes into putting these things together after all, our job as sponsors is to generate solid risk-adjusted returns for our investors. And if we can't do that, quite frankly, we don't deserve any additional compensation. We certainly shouldn't get, in my opinion, we shouldn't get any additional compensation if we get to a 7% return and nothing more, because there's a lot of places you could get a 7% return that you don't need us for, right? Again, in the appendix, we give a breakdown of our promote structure, but we included a chart here to the right that looks to compare our structure with that market structure that I alluded to before. And as you see, in our promoted interest, it starts off after investors get a 7% return, but still it's a modest amount that we would be sharing in that upside. But as investor returns improve, our share of that success increases, as it should. We're incentivized to get you the highest return that we can, and we should only be successful if you are, is the bottom line for us.
All right, so we're coming up to questions in a few moments here, but to finish this off, I wanted to tell you guys that our investment ask is total equity raise of 2.3 million is what we're looking for. Minimum investment size is $50,000, and you can ask me about self-directing your IRA or 401k. We think this is a great option. We have an administrator partner that we can refer you to. It might be a great way to escape potentially, well, for now, some of the gains that you might have on this investment. And the maximum investment size is $400,000 per investor.
Yeah, so as noted earlier, this offering is open to accredited investors and non-US persons only. So during the onboarding process, accredited investors will be asked to provide verification of their accredited investor status, either directly or to the company, or either directly to us or from their CPA, attorney, SEC accredited, SEC registered investment advisor, or registered broker dealer. This investment opportunity is open now for pledging. There's a link here on the page to our AppFolio site where you get more information and subscribe to this offering. And we're using the AppFolio investment management platform, and that makes it very, very easy to navigate and get signed up. As noted earlier, our diligence period expires this Thursday, so we're aiming to get commitments for most of that $2.3 million by then so that we can comfortably remove our contingencies. So far, we've gotten some pretty strong interest on this investment opportunity, and we're hopeful that we get sufficient interest by Thursday so that we can move forward with this opportunity. Once investors are signed up, we'll get documents loaded up into AppFolio that investors can sign electronically by October 23rd. We would then ask for funds to be deposited by November 23rd with a targeted closing date of December 23rd. We'll get to questions in a second here. We did want to walk through a couple of the appendices for you all. Appendix A covers the detailed financial information that I was alluding to earlier. It covers a 10-year period because we did look at this for various hold periods all the way through a 10-year hold period, ultimately settling in on 5. But you'll see there the details of the numbers I was sharing, as well as some of the key assumptions that we're using throughout the model. And happy to take questions on that. Appendix B breaks down the fees that as sponsors that we would be collecting from this syndication. There is a fee on there of that's known as a financing fee. we're not expecting that to be applicable because we currently are not being asked to personally guarantee these loans. If we were asked to personally put our own balance sheets and our own financial wherewithal on the line, then there would be a fee, which is pretty customary in the industry. But luckily, we're not expecting that to be the case. And then there's that waterfall that I mentioned earlier with the splits between our investors and us, depending on the IRRs that are achieved by you all. So if you're, as an example, once you get your preferred return of 7%, between 7 and 10%, we would share on that split 90-10, 10 to 12, it splits 85-15, so on and so forth. Again, to further align our interests with our investors. We mentioned earlier the development that's going on around the corner. There's a link in here to an article about this. You can see the picture here. It's going to be phenomenal. Once this mixed use development is up and running, I think it's going to be a huge benefit for our investment and ultimately the prospects of generating a return for you all.
And this is some of the information that I said I was going to share, or that I said I shared with you at the end here. You could see collections rates, vacancy rates. Collections have really improved. In fact, you'll see there that we had almost 100% collections in August, and September is not different. September has continued to improve. I've already got partial data for the month. And on the next slide, we've got information on a current rent roll analysis, so you can see exactly where we are. This is our starting point and some of the information we used to create our model. I think the next slide is sort of a thank you. Yeah, there you go. Yeah, thank you. And also additional questions. You guys could either put your questions up in the chat or you can unmute yourself and ask questions if you have them. But we're very thankful that you showed up here tonight to listen to us. We look forward to investing with you. If you have any questions, go for it.
I have a question. Has any capital improvement been done since the last 2 years on this property?
So when they bought this property, they painted the property as well as they've turned over 8 units already. I believe the seller in 2019 turned over one of the units, and they've turned over 7 units since then. Rocky, I can't think of any other major expenditures, but I have access to all the financials. So I'm going to take a look and I'll see if there were any other major capital improvements made.
I mean, apartment turning is kind of normal, right? When somebody leaves, you just fix it up.
Right.
Okay.
Yeah, and I didn't mention this earlier, Rocky. Thank you for bringing it up. Somebody asked me one time, are there any major capital expenditures necessary right at this point? And the answer is no, not that we're aware of. Based on an inspection from 2 years ago and an inspection this year, the plumbing and the electrical are in good order. Each unit has its own water heater. So, if you're replacing a water heater for $1,000, that just falls right into regular maintenance costs. And the roof that we jumped on, that we were walking on, was in good shape as well. The inspector told us that we should do some maintenance. Replace some flashings, put some, there are some low areas that we're going to put some sand up there on, but that we should have no issue making it through the next 3 to 5 years, which was music to my ears, because that's the biggest potential, I think, for a capital improvement cost. That would be a surprise that would impact our returns.
So we have a question that came through in the chat. I'm sorry.
So why didn't the previous owner do any of these value adds that we see? Thanks, Scott. I don't really know why the owner didn't do a lot of these things. The rent increases, there haven't been a lot of those during COVID, although they were allowed. They didn't do a lot of rent increases, and they did a small rent increase in July. The higher increase wasn't allowed until August of this year. In terms of creating ADUs, I don't know the answer to the question. I don't know why they didn't develop ADUs. But I see this now as an opportunity for our investors. Who knows? It could have been the fact that they'd have to dish out $300,000 to develop those ADUs, and we have the opportunity to get that as an investment from you investors now. The other major capital expenditures that we're talking about are, or the next major capital expenditure, are the turnover of the current vacancies, of future vacancies. And that could also be a cash flow impact issue, because if you think we're going to spend $10,000 to $12,000 each unit for 13 units, doing quick math in my head, that's $170,000. That is the cash for keys involved in that. There's additional costs also with time vacant. And so, you know, all that we're talking about over the next 3 to 5 years is going to be an investment of $500,000 or $600,000. In fact, I think we gave the number 577, and perhaps that's why the sellers haven't done it. Maybe they have a different opportunity. I think they're moving their money to the Bay Area or something like that.
You said 5.3% increase. What was that? Can't we have 8.6?
We can. Rents have been increasing in Long Beach at a rate of 5.3%.
Oh, I see.
You are correct. We since August 1st of this year, we are allowed to do an increase of 8.6%.
Yeah.
Next August, we're going to have a different rate that's going to be based on the
I think
CPI.
it's April, not August, April.
Yes. Well, no. In August, we can do the increase based on the April CPI. Yeah, there's a lag from when the CPI is released to when we can issue the increases based on that CPI.
Got it. Thank you.
So another question that came through the chat: once you remove the parking, does that affect the rental value of the existing units? If so, is that calculated into the expected rent roll?
So all of the units that are currently paying for the garages, well, four of them we put in, and they're paying in addition to their current rents. 4 of them have that rent built in. And so we did remove $400 of garage rent when we build the ADUs. But the truth is, we don't have to, Ashish. The law says that if we're going to remove garages for the purpose of building ADUs, that we don't have to compensate the tenant for taking those garages away. Now, in the real world, I think that we should. And of course, it depends on where that tenant is relative to market. If this tenant is paying $100 for a garage and they're $150 below market, or $100 below market, I'm probably going to give them some credit for that garage. If they're $700 below market, well, then I'm fine taking that garage away and not giving them some credit for it. Oh, and by the way, another thing I should say is we haven't done this yet, right? As soon as AB 1482 started, well, this is more with respect to ADUs, but anyways, we haven't done this in large part because of COVID. When I was speaking with our attorneys about this exact issue, they did recommend that we give a credit. And so I think it would just depend on each particular situation, and perhaps there will be some case law by the time we do this to guide us properly.
Sorry, one more thing, Mike, on that same topic as Ashish
Yep.
again. Is there enough parking on the streets for, if we have, let's say 25 new tenants, and some of them will have more than one car, I imagine, will there be enough parking to make it an attractive place to rent from, with losing all the parking?
Well, I will say this, some of the garages are already not being used for parking. Some of the garages already have a lot of stuff in them. I also think it's interesting, or it's valid, that we're removing 8 garages, and we're probably going to be able to add 5 parking spots. So in the end, we'll have a deficit of three parking spots. And to answer your question, yeah, that's not ideal, right? It's not. I don't believe it's technically a parking impacted area. I'd have to look into it. I don't think it's a parking impacted area technically, but sure, it is parking impacted. I didn't have an easy time finding a parking space when I got there for the inspection. On the other hand, this is all throughout Long Beach, Ashish. It's very common for there to be parking issues in Long Beach. and people still live in the city. Developing more units will probably create more parking issues, but I don't think this is going to have an impact on our ability to rent these units, to be perfectly honest with you. We have a lot of units in the city of Long Beach. Parking has a certain value, and that value has gone up a lot, right? It used to be 50 or 75 bucks for a garage. Now we can get much more than that, almost twice that in some cases. But everything has a value. And so as long as we're properly modeling the loss of parking, and remember, we haven't even modeled that we are probably going to be able to get $75 or $100 for each one of these parking spaces that we're creating. But I think there's still going to be demand for our product.
Thanks, Mike.
Yep.
So the architect has given okay. That's the architect who helped City of Long Beach draft.
Yes. So the architect has done a feasibility analysis. We paid him to create a report. He called the city. He confirmed that we were able to build up to 5 units, but more work needs to be done to make sure that we can add that 5th unit. And frankly, more work needs to be done to understand the exact cost of this. Now, this is some of the work that we're going to be doing over the next month when we get over this first hump, which is removing contingencies on the 23rd. But we've even modeled this with an additional $100,000 in expenses to build these ADUs. I don't think that's going to be necessary, but that lowers our IRR by 1%. And so for all the areas that we've modeled very conservative assumptions, I believe that that there are probably going to be some areas that we're going to come out also a little bit aggressive, but I think that's going to be incredibly rare. And like I said, this is our next hot topic. As soon as we get through this phase of this investment, then we're going to be working really hard to see if we could already have engaged an architect. Perhaps have drawings done or in process to be able to submit them to the city sometime very early next year and beat our 18-month ADU development projection by hopefully 6 months. But you know, that all depends on how smoothly it goes in October.
Let's say for some reason you cannot build ADUs, you know, just hypothesizing. Will it still make sense? I think we can still make it go, right? Even without ADUs?
Well, it's good you mentioned that. Michael and I ran those numbers in the very off chance that we can't build ADUs and we're still able to increase rents and do all those other things. And I think we had a 9% IRR, Michael.
Right.
Yeah. So, you know, so it's not great. It's not what we're going to design, what we've designed for this investment. But the fact that we've had a feasibility analysis is, I think, critical to moving forward. If I didn't have that, I would be scared to put my money where my mouth is in terms of a 9% IRR. I think the chance that that we're not able to develop these ADUs is very, very slim. In fact, I think things are going the other way. This amnesty program with Long Beach is relatively new. I think, and there are more laws. I wish I could give you the details now, but there are more and more laws being passed at the state level that are allowing greater density near railways. So the idea that that these density restrictions, or the opposite of, are going to not be in our favor is unlikely. I think that I think there's a very small chance we have that issue.
Is ADU, is it state or federal law?
State.
State.
Okay. So some of these apartments you mentioned, some tenants are not paying rent. Did you guys apply for rent relief with Long Beach rent relief people?
We applied for rent relief for all of them. We've applied for rent relief for every single one of our tenants, and that owed over a certain amount at different periods in the summer, because they took away the program and they added it back in and stopped it and then added it back in. So there are a couple tenants here who are not cooperating. They're not doing their part. The positive thing about that, Rocky, is that we can begin eviction on them in October. Because there's a little bit of a gray area in the change to eviction laws. We have to make a reasonable attempt to try to get money from federal sources. And the reason that that's part of the law is because it's taking such a long time. For example, Long Beach has done a really poor job administering the SB 91 funds in Long Beach. San Diego County, for example, I mean, we had funds back in July, and we're still June and July, and we're still having a hard time getting it from Long Beach. In fact, Long Beach might turn the administration of the SB 91 funds back over to the state, which would be fantastic. We'd get our money much quicker. Or Long Beach County, Los Angeles County. I can't remember which one. The point is, yes, we've applied for funds, and some of these tenants are cooperating. Other tenants are not cooperating, which is going to put us in a position to be able to evict them.
You plan to do these projects in the future also? This is the first one, looks like. So you plan to continue?
Yeah, we do if we come across the right opportunities. Michael and I, obviously, we have day jobs. This for me is exciting. This is probably the most excitement I've had in a lot of years. I've been doing management for 20 years, and as long as we can find good properties and good opportunities, I'd like to keep on doing it. But that's the most important part. The only thing the thing that would probably keep me up at night is not being able to keep my promise to investors in terms of how much return I promised them. And one day there's going to be a downturn. I don't know when, and I don't know how bad it's going to be. And that's a system. That's a market issue. And if you lose in one place, you're going to lose in another place more likely than not. What I'm concerned about is I want to make sure that all the projections that Michael and I have made for this property and any property that we do in the future are going to be good projections, and that our property does as good or much better than the general market does. So yeah, we're gonna do more if we can find them.
So we had a question.
Sorry.
Go ahead. No, go ahead.
So it's an interest-only loan for now, right? You pay-
Yes. Yes, it'll be interest only. It's interest only for the first 4 years. It's a fixed rate loan for 5 years. It is interest only for 4 years. That fourth year, it starts amortizing, and then in year 6, it'll actually be floating.
Okay. So you give, what would you get, 1099 or K1?
You get K1, yeah. This would be K1.
Okay. A couple of questions in chat.
Yeah. So I'll go backwards a little bit. Yeah, we're gonna be. Oh, Michael just responded. Yeah, we'll be sharing a link to this recording up on the Appfolio site, and this actual slide deck is on the Appfolio site if anybody needs to access it. Had another question here regarding the timing of distributions. Yeah, so we'll be looking to get funds put into escrow, end of November, so that we could close in December. So if we close in December, take ownership of it in late December, I think December 23rd is the date that we've circled, then most likely the first distribution is going to be the first completed quarter after that, since we're going to do quarterly distributions. I mean, honestly, if we buy it December 31st, there's not going to be much operating activity for those 8 days. So I would expect that first distribution to happen, right after March 31st of next year.
Thank you for the answers.
No problem.
Scott, I wonder if you're surprised about that, but the reason is because we're raising the money up front for all these major improvements. So we are projected to have cash flow in year 1, in quarter 1, and that's because we're raising funds for improvements. Now, if there are not distributions on quarter 1, I would consider that to be good news, because that means we've probably been able to move more tenants out more quickly, and we'll be able to improve the return, the IRR, by getting rents up closer to market more quickly. But of course, your reporting will have all that information, and you'll be apprised. All the investors will be apprised of that on a quarterly basis, or you can give me a call.
Mm-hmm.
All right. Any other questions out there? Good. What are we, 13 minutes late? Well, thanks everybody for hanging on and finishing the night off with us. I appreciate it. We are gonna send a link to this presentation out tomorrow, And you guys all, most of you, well, all of you have either my email address or Michael's email address. If there's something you missed, please feel free to send us an email, and we'll be happy to answer those questions for you.
Thank you, everybody, for your time. Have a great night.
All right, good evening.
Take care. Bye-bye.